Hello, and welcome to another episode of the Forex 101 series. In this episode, I'll be explaining what Forex key levels are, how to identify Forex key levels, and I'll also be giving some key advice on how to approach the Forex market. If you are new to Magna Forex Institute, Magna Forex Institute was formed to help traders approach the Forex market with the right mentality. A lot of traders out there have the wrong impression of what the Forex market really is and what to do in the Forex market. Magna Forex Institute is there to help you approach the Forex market the right way and to help you not go through the trouble that many beginner traders go through. Let's get into the video. Forex key levels are levels where price tries to reach and either finds support or resistance. Either continue moving in that direction or make a reversal. These levels can be classified as either support, which can also be considered as a floor, or resistance, which can also be considered as a ceiling. When price gets to support, it bounces off the support to start going up. And when it finds resistance, it hits a ceiling and begins to come down. These levels are where traders closely monitor price to make a decision whether to take a trade or not. These are the levels where traders make a decision to take a trade or not. So in trading, you do not take trades anywhere, anyhow. There are specific levels where you can open a trade. When you open a trade on either support or resistance, the distance of your stop loss from your opening price can be low because there is a barrier that's holding price, rather than opening a trade in no man's land. There, your stop loss will be required to be further away from your entry point. But when you open a trade on either a support or resistance level, or a floor or a ceiling, your stop loss can be closer to your entry level, and therefore you will lose less pips. These key levels differ from one time frame to another. That is, the 4-hour significant level or 4H significant level is different from the 1 hour or 1H significant level. This is why traders have different time frames for executing their trades and analyzing the direction of the trend. The higher the time frame, the more significant the key level is. The lower the time frame, the less significant the key level is. But you can find further confirmation of a lower time frame significant level with how price is moving on the higher time frame. These levels are not at a single price level, but are zones. Support and resistance levels are not just at a single price level, but it is actually a zone. There are multiple times where price may not come exactly at the price level, but it may reverse right before it reaches the price level, meaning it has tapped into the zone. Or sometimes it may rally past the price level and create a fake out and begin to start reversing. This is why it is important to mark out your significant level and draw out your zone. Let's look at this on a chart. So, as you can see here on my chart, let me enlarge it. As you can see here on my chart, I have marked out my significant levels. Here is support acting as a floor. So price came to support. It tried break below the level, but still closed above the level, meaning the support level is still a significant level. We would have considered this as a break of a key level if price closed another candle below this zone, just like it did here. Price closed below this zone and created another candle. The candle closed below the zone, meaning the level has been broken. Here is the example of support and resistance being a zone. So price came here, price broke above this level, but it never found resistance at exactly this level, but found resistance on this zone here. So it came, created a fake out, and began to retrace. Found support here and began projecting upwards. Here is an example of price finding resistance as a ceiling. So resistance and support can be interpreted as a floor and a ceiling. Most of the time, key levels can be marked out on round figure numbers. So you can see my key level here is 1700, 1600, 1800, 1900. All these levels are key levels and are marked out on the higher time frame. Higher time frame levels are more effective than lower time frame key levels. I marked out these key levels on my monthly time frame. So as you can see, these levels are being respected very, very well. Key levels must be a significant level, major and minor. For it to be considered as a key level, it has to have multiple touches. Key levels usually repeat themselves. So, by what I mean by major and minor are, major key levels are these key levels found on higher time frames, while minor key levels are these key levels found on lower time frames, usually used to take trades on. Because you cannot take a trade on the monthly time frame, it would take you a long time for price to come to that level and for price to reach your target level. So if you are a day trader or a swing trader, you use lower time frames for executing your trades. Key levels must have multiple touches. For it to be a valid key level, it has to have 2 or more touches. You can't have one touch on a level and consider it to be a key level. The level has to have a significant amount of touches for it to be considered a key level. Usually, key levels repeat themselves. Key levels can be dated back to 2016. These key levels still find themselves very significant because traders base their trades off these levels and open trades using these levels. So traders find additional confirmation on these levels and open trades on these levels. This is why these levels are continually valid as the years go by. Major levels are found on higher time frames, while minor levels are found on lower time frames. So as you can see here, this key level has multiple touches on it. We have one touch here, we have another touch here. Again, key levels are a zone and not one price level. So this can be considered as a bounce of this key level. this key zone. We have a third touch here. Let me try to go back. So this was June 2020, May 2022. This was June 2022, and this was August 2022. So you can see that these key levels continue to be valid as time goes by. We have another reaction of the key level here, January 2022. Again, let's go back. So here again, it's a zone and not one price level. Back in September 2021, we had a rejection of the zone. Price faked out, came back to find support. So this may be considered as a key level on the lower time frames because price. So here you can see another valid key level where price never really came, the body never really came to this price level 1700, but just rejected off this candle and closed above the candle, creating a morning star and started pushing upwards. So another significant level here, 1900, you can see June 2021, 1900 was tested. So we can go on and on and on. These key levels continue to be valid. March 2021, 1700 was valid. February 2021, 1800 was valid, and it continues to be valid. Major key levels are found on higher time frames. So as you can see, this is the daily, and these key levels are very, very much accurate on the higher time frame. So let's go down to the 4-hour time frame. I give you an example of how I mark out my minor key levels. So you can see here I have my, let me just delete these instruments chart. So you can see I have marked out my minor key level. So my minor key level was marked because price made a very significant move from this level. Price came to this price level here and declined very sharply. So this has I considered this as my key level. Make sure to keep your charts very clean. As you can see, my charts are very clean and easy to read, because if your chart is messy, it will be difficult for you to read price. So I bring out my horizontal ray. This is how I mark my minor key levels, and put my ray at the top of the wick here. If it was a wick below here, I would put it below here and bring out my rectangle, mark the whole wick here, and mark the whole wick. So as time goes on and price comes to this level here, we will see a reaction from this level here, 1830, a round figure. So we'll see a reaction here. We already have some reactions here. We have one here. If we stretch this one, if we stretch the rectangle far back, we can see we have a rejection again here. Another zone. So price rejected here. It really never came up to this level, but you can see that these levels are zones and not one single price level. So we have 1, 2, 3, 4. We might see another rejection from price here. So I already had this level marked out here, and price came to this level, bounced off our key level 1860. You can see price just wicked to 1860 and began to make a retracement. Right now, I'm not giving you my forecast of the market. You can find our Sunday analysis videos in the description below. Let's try to look for another minor key level. We have another minor key level here. Price reacted from this level very well. So we have multiple touches on this level. So we have 1, 2, price broke above this level, found resistance at our major key level here, retraced back to our minor key level, and began go upwards. So we could see a break of structure here. Price made a higher high. So what were we expecting? A lower high. Let me just mark out this level. Price respected the 61.8 level very well. Came down to our minor significant level, created an inside bar, and we had a moving average crossover here. Multiple confluence for us to enter this trade, and price hit our target -27. So it is important for you to have a strategy of taking profit, because most of the time price may not come to your exact target. So it's important to put your target 10 pips below the -27% level. So this is how you find minor key levels. Go down to the lower time frame. Look at how you go down to the lower time frames. Look at the flow of price and identify the key levels where price has bounced off multiple times and you are expecting price to come down to the level. Each time frame has its own levels: monthly, weekly, daily, 4-hour. I have already explained this point. Let me explain further. The time frames have their own significant levels, but the most powerful and effective are the higher time frame levels. You have already seen me give you an example of the higher time frame key levels, and you have seen that these key levels are more powerful and effective than the lower time frame key levels. Marking key levels on lower time frames just creates confusion on your charts and to your analysis. So by lower time frames, I mean time frames lower than the 30-minute time frame. If you are not an experienced trader, I suggest you do not go lower than the 1-hour time frame if you are analyzing the chart and are looking to execute a trade. When you go to the lower time frames, the key levels are less significant and you may end up opening and closing trades because price may not respect these key levels. Let me give you an example. So let's go down to the 1 minute. A lot of beginner traders love the 1 minute because they lack patience of waiting for the higher time frame key levels reached, but they end up losing trades more often and start trading emotionally. So you see how confusing these time frames are. So you see how confusing the candles on these time frames are. We just have too many price action here this time frame, which may affect the way we have analyzed our trades. So we have a significant level there, just marking out the significant levels. Have a level there. We have a level there. So you see how confusing these levels can be. You just have too many levels on this time frame. We have one there. We have another here. So you see how many key levels they are on this time frame. We have too many key levels on the 1 minute time frame, which may sometimes confuse us when we are trading on a live account, because trading on a live account and trading on a demo account are two different things. When you are trading on a live account, you usually have fear of losing your money. This is why it is important to detach yourself from the money and always risk the money that you are willing to lose. So price came here, found support, went up, found resistance, begin to start ranging, came back down, went up, came back down, went up. So all this is just confusion and may cause uneasiness to us when we are trading. But when we go up to the 1 hour, you can see how many lines we have on our chart and how many candles we have. Just a few candles created all that price action on the lower time frame. We have 1, 2, 3, 4, 5, 6, 7, 8, 9 candles, just 9 candles, and we have all these significant levels on the lower time frame, which may confuse us when we are analyzing our pair. So compared to how my chart looks on the higher time frame, the chart on my higher time frame looks more neat than the chart on the lower time frame, and the neater it is, the more confidence I have in my trades, and the easier it is for me to read price action. Support and resistance levels are not only single price, but are a zone. I have already explained this point. Let me elaborate further. Price usually does not reverse on the marked zone. It sometimes reverses before the zone, or after the zone. You have already seen me give an example of price doing this. It also sometimes does not begin to reverse at the level. It may first consolidate before it makes an impulsive move. This is why it is important to let the trade breathe. What I mean by let the trade breathe is a lot of traders, especially beginner traders, always make their stop loss small in fear of losing a lot of money. But what they do not know is before price can reverse, it may sometimes go into drawdown, begin to consolidate, and then start going into their direction. I'm sure most of you have experienced this, where you are right in the direction of price, but price just started consolidating, picking up some orders before it began the move you anticipated. But while it was consolidating, it took you out and you became emotional, started emotional trading, and overall you lost a significant amount of money. This is normal when you are starting to trade. This is why it is important to learn from your mistakes. Always learn from your mistakes in whatever you do, because the mistakes you make are what make you better overall. So always put your stop loss 30 to 40 pips away from your entry level to allow the trade to consolidate, then begin to make its move. Let me give an example of one scenario where price came to a significant level, began to consolidate, and started to make the impulsive move. Okay, here. So as you can see, this significant level, So price retraced before breaking this zone. So it retraced. So this is what price may do sometimes. So when it reaches a significant level, it will retrace just to break the zone. So you can see from here, it retraced back to this significant level in here. I would have executed a trade from here. Well, I would have executed my trade because I always wait for price to come down. I always wait for price to come up to 1.8 level. So you can see our significant level here. We draw the zone. Tested our zone perfectly. Tapped into our zone. I would have entered from this candle here, this long bearish candle here. Though my stop loss would have been further away from my entry price, I still would have entered the trade because there's too much confluence here, and the pressure here was the bearish pressure here was too much. We also had our moving average crossover, had our significant level tap, we had our retracement here. We can look for additional confluence on the counter trend break. We have a counter trend break here. So all this is just confluence for us to enter the trade. So I would have entered the trade here. Price hit TP perfectly. Again, before price began to drop here, most of you would have entered here. Or some of you would have entered. If it entered here and you put your stop loss somewhere here, you would have been taken out because you would have been scared to lose money. Let's put our position size calculator. So we open it there. Most of you would have put your stop loss right above the candle here and put your take profit there. So you see, stop loss would have been hit immediately after your stop loss hit. Price have started shooting down and hit your T. You would have and started to trade emotionally after your stop loss hit because you think the market is out to get you, and therefore start making trading errors. This is why it is important to make room for the trade to breathe. So as I said, you put your stop loss 30 to 40 pips away from your entry level. This will allow the trade to consolidate and begin its move. Let's try to look for another example. So I'm sure you get the idea. Most of the time, price will consolidate where it begins to make its impulsive move. Row reversal. Row reversal simply means support becomes resistance. Whenever support is broken, the previous support zone become resistance. And when resistance is broken, the previous resistance zone becomes support. When a key level has been broken, price usually comes back to retest it. Caution. Notice I have used usually. because it is not all the time price does this. Most of the time, price may break the support or resistance zone, but it will not come back to retest the zone. Price may sometimes continue going in one direction without making a retracement. This all depends on who is in the market at that particular time. So every single scenario in the market is different because there are different people entering the market at that particular time. There can never be the same amount of people entering a trade at the same time. There can never be the same amount of people that entered in all your trades because there may be different factors. Some people may miss out, may not participate in that particular trade. Some people may increase their volume on that particular trade. Some people may be thinking the trade is going in the other direction. So every scenario in the forex market, every scenario in the forex market is different. Trades will never repeat themselves. This is why it is important to always detach from a trade and always accept if your trade has lost. This is why it is important to detach from a trade, because trades usually do not repeat, because price usually does not repeat the way it moved on its previous trade. Again, this is why it is important to have take profit rules. So whenever price reaches a certain percentage of profit, you take your profit away from the market, so that whenever price decides to reverse before reaching your target, you have still collected something from the market. Again, every scenario in the market is different. Let me give you an example of where price failed to come back to the the support or resistance zone. So let's not even go too far. So as you can see here, price broke 1700, rallied downwards, but failed to come back and retest 1700. It continued going down. It came down, hit our target, negative 27%. People started taking profit. So you can see this consolidation here. People started taking profit. Other people started making orders because they missed this move here. So others took their profit, others entered the trade, and price continued going lower. So you see, this is a different scenario from what happened here. Price broke this significant level, but came back to test the level, continued coming down. Price still came, this is still a significant level. You can see price came back up here to test this level. Again, we also have some reaction on this level. So these levels always repeat themselves. Again, here, price broke this significant level here that we have and retested the level here. Price retested the level here. Again, we broke our significant level and came back to retest the zone. And came back to retest. Let me look for another example of where price failed, come back and retest a break of significant level here. So just bring out our, let me just bring out our horizontal line, our horizontal ray. So here, so we have our horizontal, I have drawn a horizontal line here. This is a significant level. We have one bounce here, we have one other here, we have another reaction here. So price broke this significant level, 1760. So price came to 1760, broke through 1760, but failed to come back and retest 1760. Traders began to take their profits. That's the consolidation here. We tested our moving average here and sharply climbed to 1700. Traders took their profits. Price came below, but still closed above 1760 and began reverse. Right. So as you can see, it's not every time these support and resistance levels exchange their roles. Key advice I have for you: keep your charts clean. There is nothing more destructive to your analysis than a cluster chart. Always keep your charts clean so that you can easily read price and you are not constantly closing and opening trades because price has reached a certain level and you're anticipating price to begin a reversal. Always keep your charts clean so that your mind also reads price very well. If your chart is clustered, you will not be able to read price very well, thus creating trading errors and affecting your growth in the Forex market. Let the trade breathe. I have explained this point. Stop making your stop loss too tight in fear of losing money. You'll end up losing more money. Allow the trade to breathe. Keep your stop loss 30, 40 pips away from your entry level. Maximum advice is 50 pips. Create your rules. The only thing I can say on this, the only thing I can tell you on this rule is a man who goes to war without a plan is a man who is already dead. Trading is a psychological war. A lot of people coming into the Forex market have this misconception that the Forex market is all about technicals. But technicals is the least of your problems. The reason why a majority of traders lose in this game is because they ignore the fact that trading is all about psychology. When you begin to trade real money, you will discover that trading is all about psychology. Let me give you this task. Fund an account with $10 and begin to trade that account. See if whether you are psychologically fit for this game and whether you have a rule-based strategy that you follow on a consistent basis. If you don't have a rule-based strategy that you follow on a consistent basis, I advise you create one right now, because without a rule-based strategy, you will not know what really works for you and what does not work for you. Last but not the least, trade smart and not often. A lot of traders have this misconception again that the more you trade, the more money you make. But this is wrong. The more you trade, the more money you lose, because the more you are in the market, the more you are exposing your mind to stress. Trading again is a psychological game. When you trade often, you are just setting yourself up for complete failure. Your mind and account need to relax. Whenever you get a result from your trading, an emotion gets triggered in you. If you lose, an emotion gets triggered and you begin to emotionally trade. And again, if you win, euphoria kicks in and you begin to make mistakes. One trading mistake traders make after their target has been hit is that they become too overconfident. And when they are too overconfident, traders may enter a trade without putting a stop loss or increase their lot size thinking that particular trade will not lose. Again, traders, every scenario in the market is different. No scenario in the market repeats itself. This is why it is important to have a rule-based strategy and figure out what works for you or not. It is normal for a trade to lose because you do not know how many people are in that particular market, at that particular time. You do not know what traders are thinking, whether they are thinking in line with your analysis or against your analysis. But overall, if you are consistent in the market and always adhering to your rules, you will find that in the long run, you will be profitable because your losses will be small and your gains will be more. Hope you understand what I'm saying. If you do not understand, please let me know in the comments below so that I may share more on this. We come to the end of this video. Thank you very much for watching this far. You can follow us on Instagram at Magna Forex Institute, and you can also join our Telegram channel by pasting this URL in your browser. In our Telegram channel, we post content that will never be posted anywhere else, content that helps traders grow and approach the market with the right mindset. If you have gained any knowledge from the video, please don't forget to subscribe, leave a like, and share the video. Thank you very much and see you in the next episode.